Hi guys, welcome back to my YouTube channel. In today's class, we'll be taking a quick look at 10 frequently asked accounting interview questions and how to correctly answer them. So stay with me. The first question that we have is, what is the difference between cash and accrual basis of accounting? Here is the answer. The cash basis of accounting requires that revenue should be recognized when cash is received from the customers and expenses should be recognized when cash is paid to the suppliers, while the accrual basis of accounting requires that revenue should be recognized when it is earned and expenses should be recognized when it is incurred, regardless of when cash is paid or received. The second question that we have is, what is the difference between deferred tax asset and deferred tax liability? So here's the answer. Let's start by explaining that deferred tax asset and deferred tax liability actually arise as a result of the temporary difference between the accounting treatment and tax treatment of transactions. That's number one. Then number two, what is deferred tax asset? Deferred tax asset, which is usually recognized as an asset in the books of accounts, signifies that a company has a tax savings and is going to pay less tax in the future. While deferred tax liability, which is carried as a liability in the books of accounts, signifies that a company has a future tax obligation. It means that the company is going to pay more tax in the future. The third question that we have is, list and explain 3 key financial statements, and here is the answer. The first one we have is the income statement, which is also known as the statement of profit or loss and other comprehensive income. The second statement that we have is the statement of financial position, which is formerly known as the balance sheet. And the third statement that we have is the statement of cash flow. Now let's move to the explanation. First, let's start with the income statement. The income statement is a statement that shows the financial performance of a business over a period of time, e.g. a month, a quarter, a year. It shows the profit made or the loss made. It shows the revenue. It shows the cost of sales. It shows all the expenses. So let's move on to the statement of financial position. The statement of financial position is a snapshot statement that shows the financial wealth of a business. It shows the asset of the business. It shows the liability that are owed by the business, and it shows the equity of the owners of the business. Then the third one is the cash flow statement. The cash flow statement is a statement that shows the cash movement of a business over a certain period of time. The fourth question that we have here is, what is the difference between contract asset and account receivables? This question is best answered when you read up IFRS 15, but let me give you a summary. Contract asset is used when the right to receive payment is based on a condition other than the passage of time. It means that you have rendered a service to someone, but the person is saying that for them to pay you that particular amount that they owe you, there is a condition that you need to fulfill. It's not just about passage of time. They're saying, oh, maybe you tutor them. They're saying, for me to pay you this amount, you've tutored me for 3 months, yes, but for me to pay you this particular money, I have to pass this exam. So there's a condition attached, and you're gonna recognize that amount on that contract asset. While account receivable, this is used when the right to receive payment is unconditional. Other than the passage of time, you don't have any other condition that is attached. So the fifth question that we have is, what is the difference between depreciation and amortization? And here is the answer. Depreciation is the systematic allocation of the cost of a fixed asset over its useful life, while amortization is the systematic allocation of the cost of an intangible asset over its useful life. The difference between depreciation and amortization is depreciation refers to fixed assets, while amortization refers to intangible assets. The sixth question that we have, we're making good progress, okay, is, what is a bank reconciliation statement? A bank reconciliation statement is a statement that is used to reconcile the discrepancy between the actual bank statement and the bank statement that you have on your books. So the bank statement might be showing a figure of 200,000 and your book is showing a balance of 100,000 naira. So the bank reconciliation statement helps you to reconcile those two different balances. Seventh question we have. Before we move to the seventh question, I just wanted to remind you that you should subscribe to our YouTube channel so that you don't ever miss on any of our content and you get notified whenever we drop any valuable content like this one. Apart from that, that's just your little way of compensating us and thanking us for the effort that we put into making these videos. So just take a minute and please subscribe to our channel. Thank you so much. Once you're done subscribing, please head to the comment section and type I have subscribed. I have a little gift for you. Thank you so much. So let's move on to question 7. The 7th question we have here is, what is the rate for pension contribution in Nigeria? In Nigeria, we currently use a contributory pension scheme where the employer is required to pay a minimum of 10% of the basic housing and transport, while the employee is required to contribute a minimum of 8% of the basic housing and transport allowance. So the 8th question that we have is, answering with a yes or no, is withholding tax a type of tax? The answer is no. Withholding tax is not a type of tax. It is an advance payment of income tax. There is no separate law that accounts for withholding tax. The 8th question that we have is, according to IAS 2, how is inventory valued? So this is the answer. According to IAS 2, inventory is valued at the lower of cost and the net realizable value. Yes, guys, we are the last question, which is, what is the difference between a debit note and a credit note? This is the answer. A debit note is issued by a buyer to the seller to return goods that have been purchased, and it signifies a reduction in the amount receivable in the book of the seller. So if I am a seller and I get a debit note from one of my customers, it means that the amount the customer is expected to pay me is going to reduce. That is that about debit note. Now, moving on to credit note. A credit note is issued by a seller to a buyer, acknowledging a debit note that was once received. So the buyer must have sent a debit note to the seller, and the seller is now acknowledging that he got the debit note. That's what the credit note is for. One, or the credit note is issued to correct a discrepancy in an invoice that was raised before. A credit note signifies a reduction in amount payable in the book of the buyer. So moving on to the last one, we have come to the end of this part 1. Please subscribe to our YouTube channel and sit down and wait for the part 2 of this series. I hope you got value. If you got value, please head over to the comment section and let us know. Once again, don't forget to like, comment, share, and subscribe to our YouTube channel. Thank you very much, and I'll see you in the next one. Bye.